Good evening from New York. It's 10:02 p.m. on Monday, March 30th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are closed for the evening, and what a session it was. We had oil breaking triple digits, Powell speaking at Harvard, Micron in free fall, and the Iran war widening on multiple fronts. Walk us through what happened.
This was a session defined by the collision of two powerful forces, a wartime energy shock and a central bank explicitly telling the market it will not flinch. Let me give you the numbers. The S&P 500 closed at $6,343.75, down 0.39%. The Nasdaq fell harder, down 0.74% to $20,792.84. The Dow actually eked out a gain, up 0.12% to $45,219.30, carried by its energy and defensive tilt. The Russell 2000 was the real casualty, down 1.44% to $2,414.49. Small caps are getting crushed by the energy cost pass-through. The VIX sits at $30.61, which tells you fear is elevated but not panicked. The 10-year yield closed at 4.34%, the 2-year at 3.60%, giving us a 74 basis point positive spread on the yield curve. And the advanced decline ratio was ugly, just 182 stocks advancing against 328 declining. This is a market under broad distribution pressure with very narrow leadership.
The headline everyone's watching is oil, WTI above $100 for the first time since 2022. How do you frame the magnitude of what's happening?
According to CNBC, WTI settled at $102.88, up 3.25% on the day, and Brent closed at $112.78. But the daily move understates the story. WTI has surged roughly 53% in March alone. Brent is up approximately 55% this month, which CNBC reports is the largest monthly gain since the contract's inception in 1988, surpassing the 46% spike during the first Gulf War in September 1990. We are in historically extreme territory. The catalysts keep compounding. Trump told the Financial Times on Sunday his preference is to take the oil in Iran and potentially seize Karg Island, through which roughly 90% of Iranian exports flow. On Monday morning, he escalated further, threatening to completely obliterate Iran's power plants, oil wells, and Karg Island unless the Strait of Hormuz is immediately reopened. Meanwhile, Yemen's Houthis launched their first direct missile strikes at Israel over the weekend, and Iran attacked aluminum smelters in the Gulf. Emirates Global Aluminum's Al Tawila facility sustained what they called significant damage. Kuwait reported strikes on a desalination plant. The war is no longer a bilateral conflict. It is a multi-front regional conflagration touching energy, metals, water infrastructure, and shipping lanes simultaneously.
And Société Générale is floating the possibility of $150 a barrel. What's the mechanism that gets us there?
Michael Hay at Société Générale laid it out clearly on CNBC. The Strait of Hormuz is already effectively closed, choking off Iranian and a portion of Gulf exports. The second choke point is the Bab el-Mandeb Strait, where the Houthis operate, which carries 4 to 5 million barrels per day connecting the Gulf of Aden to the Red Sea and the Suez Canal. If both choke points are simultaneously blocked, you could see up to 9 million barrels per day removed from global flows. That's nearly 10% of global supply gone overnight. Even the current disruption, with just the Hormuz blockade, is enough to sustain prices well above 100. But let me trace the faux causal chain, because this is where it matters for portfolios. Oil above 100 feeds directly into jet fuel. According to Airlines for America data cited by CNBC, jet fuel prices averaged $4.57 a gallon last Friday, up nearly 83% since the day before the war began. JetBlue is already raising checked bag fees by $4 to $9 per bag. That's the transmission mechanism at work in real time, crude to jet fuel to airline surcharges to consumer wallets. Simultaneously, Chinese manufacturers are warning of 5 to 20% price hikes on petroleum-derived goods, from propylene pickleball paddles to polyester scarves. A supply chain consultant in Shanghai told CNBC that if this extends into May, there will be triage between industries for petroleum-derived materials. So you have a commodity shock radiating through airlines, consumer goods, industrial inputs, and food distribution simultaneously.
Which brings us to Powell, because the question every investor asked today was whether the Fed would respond to this with rate hikes. What did he actually say?
Powell was unambiguous. Speaking at Harvard, he said inflation expectations remain well anchored beyond the short term. The current Fed funds target of 3.5 to 3.75% is a good place, and the Fed should look through the oil supply shock, because by the time any tightening would take effect, the shock would likely be gone, and you'd be weighing on the economy at precisely the wrong moment. This is textbook Fed supply shock doctrine, and it landed with force. According to CNBC, rate hike odds by December collapsed from above 50% Friday morning to just 2.2% after his remarks. Here's how the bond market confirms it. The two-year yield at 3.60% is sitting right at the lower bound of the Fed funds range. That tells you the market is pricing virtually zero probability of further tightening and is leaving the door cracked for eventual easing if the energy shock tips the economy towards recession. The 10-year at 4.34% with a 74 basis point positive spread reflects that the long end still sees some term premium, likely inflation risk premium from oil, but is not pricing in a rate hiking cycle. Powell also made a notable comment about private credit, acknowledging rising defaults, investor withdrawals, and concerns about the $3 trillion sector, but said the Fed does not yet see systemic contagion to banking. That's worth monitoring because financial services breadth is already dire, as I'll get to.
So the Fed is on hold, but does the market believe it can stay on hold if oil stays above 100 for another quarter?
That's the right question, and it's why the VIX is at 30 and not 20. Powell explicitly cited the 5-year break-even rate at around 2.56% and trending lower over the past 10 days as evidence that inflation expectations remain contained. The market is giving the Fed the benefit of the doubt today, but if oil stays above 100 through the second quarter, you'll start seeing that contamination into core inflation through transportation costs, materials, and food. Cisco, the food distributor, was down 7.42% today. The market is already pricing that margin compression into the companies most exposed to fuel surcharges. The risk is not that the Fed hikes tomorrow. The risk is that 3 months from now, break-evens start drifting higher, and by then the Fed has lost the option to act preemptively. For now, the hold is the correct call, and the market agrees.
Let's get specific. Who are the clear winners and losers from today?
Start with the losers, because that's where the pain is concentrated. 7 of the top 10 daily losers are technology names. Micron led the carnage, down 11.3%, extending a 30% decline since its March 18th earnings report, and this despite a blowout quarter driven by AI memory demand. CEO Mehrotra told CNBC that customers are only getting half to two-thirds of their supply requirements. The stock is being sold not on fundamentals, but macro fear and the gravitational pull of a supply-constrained environment where even good earnings can't overcome risk-off sentiment. The damage radiated through the memory and storage ecosystem. Western Digital down 10.93%, SanDisk down 10.92%, Seagate down 8.18%. Ciena, an optical networking company, fell 11.2%. Corning lost 8.72%. Teradyne semiconductor test equipment down 8.17%. This is not stock-specific. It is a sector-wide liquidation of anything touching semiconductors or tech hardware. Now look at the sector breadth to understand how deep this goes. Technology, the largest sector at $18.89 trillion in market cap, has just 13.41% of its stocks above the 50-day moving average, 0% near 52-week highs, over 20% near 52-week lows. That is a sector in broad-based breakdown, not a selective correction. But it's not just tech. Consumer cyclical, $6.29 trillion in market cap, has only 3.77% of stocks above the 50-day moving average and nearly 23% near their lows. Real estate is even worse, 48.39% of stocks near 52-week lows, the most extreme reading on the board, as higher for longer rate expectations and rising recession risk crush REIT valuations. Financial services, a $7.57 trillion sector, has just 4.29% of stocks above the 50-day moving average and under 3% near highs. This is a massive sector being quietly devastated, while the headlines focus on oil and tech. Industrials, at $4.77 trillion, have only 5.58% above the 50-day moving average and 0% near highs. These are not minor sectors. Combined, technology, consumer cyclical, financials, and industrials represent over $37 trillion in market cap, with
It's flowing into two places. Energy is the undisputed structural winner. 100% of energy stocks are above both the 50-day and 200-day moving averages. Nearly 82% are near their highs, 0% near lows. That's a $2.32 trillion sector in universal uptrend. Utilities are the second haven, 80.65% above the 50-day, nearly 71% near highs, 0% near lows. That's classic defensive rotation. When the VIX is above 30 and the macro outlook is this uncertain, capital gravitates to yield and energy exposure. On the cyclical winners side, ServiceNow led the gainers, up 4.93%. Enterprise SaaS with recurring revenue is being treated as a defensive growth trade. TKO Group Holdings gained 4.06%, benefiting from live entertainment's insulation from energy cost pass-through. Arthur J. Gallagher, the insurance broker, rose 3.82%. Geopolitical risk repricing directly benefits insurance premium growth. Workday and Salesforce also rallied, up 3.35% and 2.73% respectively, as the market rotated into enterprise software resilience.
Let me ask about the Magnificent Seven specifically. NVIDIA was down over 2% today. How damaged is this cohort?
Severely. NVIDIA closed at $165.06, down 2.18% on the day, down 5.72% over 5 days, and down 12.53% year-to-date. It's trading well below its 50-day moving average of $183.05 and below its 200-day at $179.32. Tesla fell 2.89% to $355.28, down 7.24% in 5 days and nearly 19% year-to-date, also well below both moving averages. Meta Platforms was essentially flat on the close at $536.38, but the damage is already done. It's down 9.54% in 5 days and almost 17.5% year-to-date, trading at 536 against a 50-day of 641 and a 200-day of 685. Microsoft closed at $358.76, down nearly 1% on the day and down almost 24% year-to-date. It's trading more than $50 below its 50-day and over $118 below its 200-day. Alphabet fell 1.06%. Apple lost 1.38%. Every single Magnificent Seven name is below its 50-day moving average. This is not a rotation within growth. It is a broad repricing of the entire megacap technology complex.
There's a corporate signal embedded in the Micron story that I want to pull on. AI demand is clearly booming. The Rebellion's chip startup just raised $400 million. NVIDIA-backed Reflection AI is raising $2.5 billion, but the stocks are going the other direction. What's the disconnect?
It's the classic late-cycle tension between secular demand and cyclical funding conditions. AI memory demand is genuinely insatiable. Micron's CEO said customers are getting half to two-thirds of their requirements. The South Korean startup Rebellions can't secure enough memory supply. But when oil is above 100, the VIX is above 30, and the 10-year is at 4.34, the cost of capital rises, risk appetite contracts, and even companies with blowout demand get sold because the marginal buyer is raising cash, not adding positions. Micron is up 270% from a year ago. That's an enormous amount of embedded profit that becomes a source of liquidity in a risk-off environment. The AI secular story is intact. The cyclical funding environment is hostile. Those two forces are at war, and right now, the cyclical is winning.
What's the risk case investors should be stress testing from here?
Our base case, which we'd assign a 55% probability, is that we muddle through in a range. S&P 500 between 6,200 and 6,420, 10-year yield between 4.25 and 4.50%, WTI between $98 and $115, the Fed holds at 3.5 to 3.75 through at least September. Powell has removed the rate hike tail risk, but oil above 100 and the Hormuz blockade sustain elevated volatility, keeping equities range-bound with a modest downward bias as energy costs pressure margins and consumer spending. The risk case, which I'd put at 30% probability, is materially more dangerous. If the U.S. executes a ground operation on Karg Island, or if the Houthis successfully blockade the Bab al-Mandeb Strait, you could lose an additional 4 to 5 million barrels per day on top of the Hormuz disruption. That pushes Brent toward the Societe Generale $150 scenario, WTI to 130 to 150. At those levels, the S&P reprices to around 58.50 as the market prices 15 to 20% earnings risk from an energy-led recession scare. The 10-year likely spikes toward 4.60% on surging break-evens, even as the Fed holds, creating an agonizing divergence between inflation expectations and monetary policy. The causal chain is Karg Island seizure triggers Iranian retaliation against Gulf infrastructure, Houthis close Bab al-Mandeb, 9 million barrels offline, oil spikes to 150, break-evens surge, consumer spending collapses, corporate margins compress, broad risk-off liquidation.
And the upside tail?
15% probability. Trump claims Iran has agreed to most of the 15 points in the U.S. peace plan and says Iran has allowed up to 20 oil-laden boats through the Strait of Hormuz as a sign of respect. If that turns into a concrete ceasefire and immediate strait opening, oil normalizes rapidly towards $70 to $80, the VIX collapses below 20, and you get what Ackman is calling a peace dividend. The S&P could rip to 6,700 as all those beaten-down growth names trading well below their 50-day averages snap back violently. This is the scenario Ackman is positioning for when he says it's one of the best times in a long time to buy quality stocks. His Pershing Square fund is down 19% year-to-date. He's putting his conviction behind the asymmetry.
So, how should investors position across those scenarios?
Highest conviction, maintain or increase energy producer exposure immediately. The structural breadth is perfect, 100% above both moving averages, and the supply-demand imbalance is not going away even in the base case. Secondary conviction, utilities as a structural defensive allocation, 81% above the 50-day, 71% near highs, 0% near lows. This is classic defensive rotation. When the VIX is above 30 and the macro outlook is this uncertain, capital gravitates to yield and energy exposure. On the cyclical winners side, ServiceNow led the gainers, up 4.93%. Enterprise SaaS with recurring revenue is being treated as a defensive growth trade. TKO Group Holdings gained 4.06%, benefiting from live entertainment's insulation from energy cost pass-through. Arthur J. Gallagher, the insurance broker, rose 3.82%. Geopolitical risk repricing directly benefits insurance premium growth. Workday and Salesforce also rallied, up 3.35% and 2.73% respectively as the market rotated into enterprise software resilience.
how does it all fit together?
When you step back, this is really about a market caught between a wartime energy shock and a central bank that's explicitly chosen not to respond to it. Powell's decision to look through the oil spike is the single most consequential macro call of the session. It removes the rate hike tail risk, but leaves the economy exposed to the full force of cost pass-through from $100 plus oil. That creates the unusual regime we're in. Bonds and equities are both under pressure, but from different sources. Equities are repricing growth and margins as energy costs cascade through airlines, manufacturers, and food distributors. The long end of the curve is absorbing inflation risk premium. Commodities and commodity-exposed equities are in their own isolated bull market. Meanwhile, the breadth data reveals a market where two sectors, energy and utilities, are carrying the entire burden of positive momentum across nearly $75 trillion of S&P market cap. That concentration is fragile. The alternative view deserves serious consideration. Ackman's thesis is that this is one of the most asymmetric setups in years, that the war ends sooner than the market expects, oil collapses, and the names now trading 20 to 30% below their 50-day averages become generational buying opportunities. The 5-year break-even at 2.56% and falling supports the argument that the market still believes the inflation impulse is temporary. If that's correct, and a ceasefire materializes, the snapback in growth names could be violent and swift. That's not a base case, but it's a real possibility that disciplined investors should leave room for. 3 takeaways. First, the risk. The Bab el-Mandeb Strait is now the key variable. If the Houthis blockade it alongside the Hormuz closure, we enter a supply disruption scenario that has no modern precedent, and equity markets reprice accordingly to 5850 on the S&P. Monitor that choke point above all else.